Hey everyone, and welcome to this explainer. Now, as a financial advisor, I spend a massive amount of time looking at market trends, right? But today, we are zooming way out to look at something much, much larger. We're going to do a macro risk assessment of the entire global financial system. Because look, right now, the financial world is quietly rewiring itself. Most people have absolutely no idea it's even happening, but global reserves literally just hit their lowest level since 1992. So today, we're going to uncover what this silent, systematic shift away from the US dollar actually looks like, how it functions under the hood, and honestly, most importantly, what the loss of this monopoly means for everyday domestic markets and your own personal purchasing power.
Okay, so here's our roadmap for today. We're going to cover Section 1, the ultimate financial cheat code. Section 2, triggers for dollar diversification. Section 3, bypassing the U.S. banking hub. Section 4, the BRICS digital currency threat. Section 5, the rise of global optionality. And finally, Section 6, impacts on personal purchasing power. Let's dive in.
The ultimate financial cheat code. All right, to really understand this risk, we first have to set the baseline. Think back to following World War II. When most of Europe and Asia were basically rebuilding from scratch, the US was one of the last major economies still standing. Because of that, the US dollar just naturally fell into place as the undisputed backbone of global finance. And that pure necessity created what is arguably the ultimate financial cheat code: $200 billion. That's the estimated amount the United States saves every single year simply because global countries are forced to hold dollars in their reserves. Because the rest of the world needs dollars to trade, they're forced to buy US Treasury bonds. I mean, it's a pretty sweet deal if you can get it, right? It guarantees constant demand and gives America access to the absolute cheapest capital on Earth. It is literally the invisible engine powering our domestic economy.
But here's the reality check. We're seeing a slow, silent, and steady decline in the dollar's absolute dominance since the turn of the century. Look at the year 2000. The dollar was the undisputed heavyweight, making up 71% of global reserves. Fast forward to 2010, and it slipped to 66%. Still totally dominant, sure, but definitely shifting. And today, it's sitting below 58%. So you see, this isn't some sudden dramatic crash. It's a structural leak.
Section 2. Triggers for dollar diversification.
So you might be wondering, why the leak? What is actually motivating nations to walk away from a system they've relied on for nearly 80 years? Well, if we trace the historical triggers, a really clear pattern emerges. Following the 2008 financial crisis, the Federal Reserve's quantitative easing programs made central banks around the world pause and say, wait, are we way too concentrated in dollar-denominated assets? Then came 2014. The U.S. imposed sanctions on Russia, and that kicked off a really serious partnership between Russia and China to start building alternatives to the dollar infrastructure. The whole conversation changed from just concentration risk to jurisdictional risk. They started asking, what happens if Washington simply decides we can't use dollars anymore?
Now, I want you to step into the shoes of a central bank official for a second. Imagine evaluating the events of 2022. The US and its allies froze roughly $300 billion in Russian sovereign assets and completely cut them off from SWIFT, which, if you don't know, is essentially the WhatsApp for global banking. Now, whether you agree with the politics of that move or not, and impartially speaking, that's totally beside the point here, the signal it sent to every single central bank on Earth was absolutely deafening. The system you depend on for your nation's survival, it can just be switched off. Suddenly, finding a backup plan wasn't just a fun financial thought experiment, it became a literal national security priority.
Section 3. Bypassing the U.S. banking hub.
To build that backup plan, rival nations had to figure out how to bypass the old system entirely. You see, for decades, international trade was strictly tethered to U.S. infrastructure. Think of the old correspondent banking system, kind of like a mandatory layover flight. If you were a central bank trying to settle a trade between, say, Brazil and China, two countries with zero direct connection to the United States, you couldn't just fly direct, no way. You had to route that transaction all the way through New York. Both central banks would hold accounts at a U.S. correspondent bank, like a Citi or JP Morgan, and they would facilitate the trade. Every single payment touched the American financial system simply because there were no other liquid markets available.
So the crucial takeaway here is that this mandatory routing wasn't just about empowering global trade. It gave the U.S. what economists literally refer to as exorbitant privilege. Sounds a bit dramatic, sure, but it fits perfectly when you look at its three pillars. First, intelligence. Routing through New York means moving data, giving the U.S. a bird's-eye view of exactly who is buying and shipping what all over the globe. Second, investment. That constant forced demand for dollars means the world absolutely has to buy U.S. debt, which keeps our domestic interest rates nice and low. And finally, jurisdiction. the ability to act as the supreme global regulator, which, by the way, is exactly how those 2022 asset freezes were mechanically possible in the first place.
Section 4. The BRICS digital currency threat.
Eventually, rival nations decided they'd had enough of this infrastructure of control. But here's the catch. Replacing an 80-year-old system requires massive, highly coordinated effort. It starts with the sheer economic gravity of the BRICS coalition. Individually, these emerging markets couldn't even make a dent in the Western-led financial system, but collectively, that's a different story. And BRICS expanded massively in 2024, pulling in countries like Saudi Arabia and the UAE. Collectively, this group now represents more than a quarter of the global economy and nearly half of the entire world's population. They aren't just meeting up to do business anymore, they are actively sharing the physical infrastructure needed to route trade totally outside the old rules.
And this brings us to what is honestly one of the most critical yet completely underreported developments for 2026. It's called the Unit. This is a blockchain-based settlement tool that's moving right into an operational pilot phase. It's backed 40% by physical gold and 60% by a mix of BRICS currencies. Its specific ultimate goal is to break the dollar's deepest and least visible monopoly, the pricing of global commodities. Right now, commodities like oil are both paid for and priced in dollars. The unit is designed to step in as a completely neutral measuring stick, effectively removing the US dollar as the mandatory reference point.
But the unit is just the concept, right? It needs actual infrastructure to run on. And that is exactly where Mbridge comes in. This is a blockchain-based cross-border payment platform that actually went live in 2024. These are the literal pipes. This technology allows nations to trade directly with each other without using correspondent banks. That means no JP Morgan, no New York layovers, and completely removing US oversight and data tracking from their bilateral trade. It's a massive workaround.
Section 5. The rise of global optionality.
So what Mbridge and the unit really represent is a monumental shift in global finance. We are looking at a stark contrast between the old world and the new. Historically, U.S. financial influence was a classic hub-and-spoke model. Everything routed through U.S. hubs, under U.S. jurisdiction, with commodities priced in dollars. The new multipolar alternative, it's totally decentralized. It relies on direct bilateral trade, digital networks like Mbridge, and a massive return to neutral assets like central bank gold reserves. It is a completely, fundamentally different architecture.
And we are already seeing the symptoms of this new optionality absolutely everywhere. Just look at these diverse signals. Central banks have been buying up gold at the fastest pace in modern history since 2022. Brazil and China are actively settling bilateral trade in their own local currencies. India literally just completed a purchase of UAE crude oil using Indian rupees. And Saudi Arabia is openly discussing accepting Chinese yuan for oil sales. Now, none of these single events on their own kills a monopoly, but the compounding accumulation of them, it absolutely does. Because at the end of the day, optionality is the ultimate monopoly killer.
Section 6. Impacts on personal purchasing power.
Okay, so as a financial advisor, this is where I need to bring this massive global macro story right back to your front door. How does all this international rewiring actually hit the average citizen's wallet? Let's look at how this builds into a very, very real domestic risk. Remember that $200 billion cheat code we talked about? That exorbitant privilege? Well, if the rest of the world stops being forced to buy U.S. debt just to facilitate their own trade, the demand for that debt drops. And if demand drops, borrowing costs go up. Losing that cheap capital directly threatens the low interest rates that have historically propped up our housing markets, supported our domestic credit markets, and sustained your everyday consumer purchasing power. Your daily cost of living is intrinsically tied to global reserve demand.
Which leaves us with a really critical question to consider today. The data clearly shows that the dollar's global monopoly is mathematically declining as these alternative infrastructures come fully online. So, in a world where the ultimate financial cheat code has finally expired and global liquidity is totally fractured, how insulated are your personal savings against this new, multipolar financial system? It's a fundamental shift in macro risk and something every serious long-term investor needs to be carefully evaluating right now. Thank you so much for joining me for this explainer.